Today in crypto land, the Bitcoin ETF is delayed once again, surprising a grand total of no one. Incoming cryptocurrency regulations might make it even less private than it already is to use centralized exchanges. Poloniex delistings may be a sign of things to come, and Craig Wright just won't go away. And let's start off with Craig Wright. He is at it again, filing a copyright claim for Bitcoin. Defook, Craig. This is the worst kind of trolling and 100% what Satoshi would not have done. The fake Toshi team was quick to claim victory, saying this is the first government agency to give recognition of Craig Wright being Satoshi Nakamoto. But is it really? No, of course not. Like all of the Craig Wright fraud, this is another deception because the act of registering a copyright is something that anybody can do and involves no official oversight. Just a piece of paper and $35 submitted to the Copyright Office. That's it. The Copyright Office does not investigate the validity of the claim. They just register the claims. So if someone else wanted to register a claim, then they can go and do that for $35. And it is up to the courts to then decide whose claims are actually valid or not. And yet the story becomes even stranger because Satoshi's white paper was copyrighted on publishing. And should farther copyright claim be required, then there was actually a 5-year limit on that claim, meaning that Craig Wright is 5 years late. Also, a big problem with Craig Wright's claim is that no such thing as being awarded a copyright actually exists under US law, as the BSV crowd is claiming. Now, why would he do this? Publicity aside, there is the real possibility now that Craig Wright tries to pursue copyright infringement lawsuits against Bitcoin and Bitcoin Cash, and possibly anyone else using Bitcoin Codebase, which is a lot of different cryptos actually, as the cult of Craig deems that there is only one Bitcoin, Bitcoin Satoshi Vision. But Bitcoin is already under an MIT copyright license, which permits anyone to reuse the code with impunity. Do you want to know who filed that copyright? Satoshi Mother Duckin' Nakamoto back in 2009. And why did Satoshi do this? Because Satoshi wanted Bitcoin to be available for everyone with no barriers. This is something Craig would never have done. Trying to file a claim now in order to patent troll and sue everyone is another definitive nail in the coffin that Craig Wright is not Satoshi. The mountain of evidence against him is completely damning. Jameson Lopp recently published a massive and incredibly comprehensive expose showing why Craig Wright is definitely not Satoshi. And yet, Craig Wright does everything in the realm of possibility to try and prove that he is Satoshi Nakamoto, except the one and only thing that would actually prove he is Satoshi Nakamoto, signing a transaction from one of Satoshi's known addresses. How anyone actually finds the Bitcoin Satoshi Vision compelling is beyond me. This is more theater to give this fraudster a platform to pump his coin and to attract more lost souls into the cult of Craig. Although you have to give it to him. That is $35 incredibly well spent on marketing. Every major publication is leading with this story today, unfortunately leading more unwitting souls into the depths of the madness that is the cult of Craig. Crazy. Anyway, on to a vaguely more important story. Our good old mates over at the SEC have postponed verdict on the Van Eck and Bitwise ETF applications. Again. The SEC has added an additional 35-day period for gathering more information and public opinions on the matter. The SEC has released a set of questions open to the public about the proposal with the intent of using the provided answers to aid them in reaching a final verdict. The questions specifically pertain to topics regarding protecting investors and public interest from fraud and similar exploitations. Should you so wish to comment or to read these questions, there is a link down below in the description. With the new delay, VanEck's deadline is moved back to August 19th. The SEC can and probably will delay one more time, making a final verdict by October 18th. And you have to keep it real, guys. Love or hate the Bitcoin ETF, it is coming, and it's likely to make a big splash on the markets when it does. This, combined with the various futures contracts that are being pushed through by Bakkt and other players like that, will make a very large, liquid, and a very robust market for institutions to pile into Bitcoin without needing to directly hold the asset. And a recent report by Dyer actually outlines how April and May have been record months for CME Bitcoin futures markets, topping 4.8 billion in April and 6.6 billion in May, which of course is not yet finished. So we can expect to see an even bigger number for May by the time we finish that up. The big danger, of course, is if Bitcoin products are sold without one-to-one underlying support, and that they are then able to have this paper inflation and manipulation. So let's hope that we do maintain seeing these backed products. But hey guys, we don't need Wall Street. But they're coming to the party anyway, whether we want them to or not. And even less than Wall Street, we don't need US regulators, because they are only playing a power game, trying to control and dominate the industry, as our next story so direly illustrates. The Financial Action Task Force, or the FATF, an organization you probably don't know much about, but which is devastatingly influential, is set to finalize new standards for regulating cryptocurrency firms next month. This is a story that has actually been developing over the course of the past few months, and after a meeting earlier this month between hundreds of industry representatives and a board of regulators who were basically completely uninterested in what those industry representatives actually had to say, or at least it seems that way, as the regulators will be pushing for the most draconian options on the table in order to regulate crypto firms. Those standards will very likely make crypto exchanges, wallet providers, and other related companies subject to something called the travel rule, which has long been followed by correspondent banks around the world. This would go way beyond the basic know your customer rules that we are so familiar with in crypto land, because in addition to verifying and keeping records of their own users' identities, exchanges and other service providers, like some of the wallet services we know, would have to pass customer information to each other when transferring funds, just as banks are currently required to do. That means that any transaction in or out of an exchange or a wallet provider will be taken back into the equivalent of the financial Stone Age, with the very kind of BS that crypto is trying to get around. Just imagine the nightmare in terms of compliance in sending Bitcoin from your Coinbase account to a friend's Exodus wallet account. Coinbase and Exodus would both have to exchange both of your KYC details in order to allow it to happen, essentially making your transaction fully transparent, and then registering the owners of those crypto addresses. Rightfully so, industry representatives has said that this requirement would be onerous, if not unworkable, for crypto businesses, and of course terrible for user privacy, in that it would only really succeed in driving users away from regulated platforms. It is very much worth keeping in mind here too that FATF recommendations aren't legally binding, but traditionally countries that don't follow their recommendations can find themselves blacklisted in the global economy. Also worth keeping in mind that even if they do pass these new recommendations, that the requirements wouldn't take effect overnight. Member countries would first have to pass legislation or to write rules putting the recommendations into effect. So it could take years to see this actually be implemented, but due to the power and the influence of FATF member states, the downstream consequences could be very impactful for non-member states who may simply be forced to apply laws which go against their own wishes due to the threat of being blacklisted from the global economy, should they, of course, fall into any kind of non-compliance. Now, take a guess. Which country is currently holding the presidency of the FATF? You got it. It's the United States, guys. And in spite of advocacy from hundreds of high-level industry representatives, they are set on finalizing these new standards. Of course, the US gets its hands on something and rushes to screw everyone and to reduce personal liberty as much as possible. Thanks, America. Appreciate that. Even more financial tyranny is rolled out in the last-ditch effort to defend the petrodollar. It's crazy. Maybe if we can get a more sensible country in charge next year, they might reverse this, but considering the power that the United States exerts over other states, it's relatively unlikely because the FATF is the brainchild of the G7 group of countries created with the aim to combat money laundering and terrorist financing. And their proposed standard that the US is pushing seeks to prevent these kind of actors from exploiting cryptocurrencies to fund terrorism or launder money. As we have covered extensively here on the channel, bad people do bad things. Usually with dollars, sometimes with crypto. All those regulations that we have right now have not stopped terrorists from getting money. And when it comes to money laundering, look to London. Look to Wall Street. These are the kings of the universe when it comes to money laundering. The tiny amount of money laundering that may happen in the crypto industry doesn't even compare to the massive fraud and money laundering committed by the highly regulated banks. They have lots of regulations and oversight. Hasn't stopped them. They are quoted as saying some of the features of emerging technologies that appeal most to users and businesses, like speed of transfers, rapid settlement, global reach, and increased anonymity, can also create opportunities for rogue regimes and terrorists. This can be looked at in the lens of the increasing pressure from the Western powers, which are continuing to push sanctions, also known as, of course, financial tyranny, on their political enemies. It is not a mistake that this is coming at a time that Iran and Venezuela and Russia are all looking to get into more crypto-based solutions. And at the same time, we see more and more pro-war rhetoric increasing against those countries. Our liberty is being sold with the false promise of safety, or as Benjamin Franklin put it, those who would give up essential liberty to purchase a little temporary safety deserve neither liberty nor safety. Wise fellow, old Ben. Make no mistake that Bitcoin is challenging the power of the petrodollar. They would not be taking the time to make these kinds of crushing regulations if they were not genuinely worried about its potential impact. While the FATF regulations may take a long time to come into effect or be reversed by another government or other government bodies, it is definitely a worrying trend towards the obsessive control that governments want to have over the financial system. Now, more than ever, we need good, robust, liquid DEXs. Nash, come and save us! Thus, of course, given the context of today's video, the announcement from Poloniex to delist 9 coins for US customers due to regulatory uncertainties came as little surprise. Ardor, Bytecoin, Decred, Game Credits, Gas, Lisk, Next, Omni, and Augur are all being denied to US customers on the platform. So much freedom, guys. So much freedom. Poloniex said, "We are committed to complying with regulatory requirements in every jurisdiction. Today's action is a result of regulatory uncertainty in the US market. Specifically, it is not possible to be certain whether US regulators will consider these assets to be securities. This is based on guidance from US regulators why they made this decision. Duck a duck, guys. If this spreads, we could see a significant proportion of the crypto economy coming under the chopping block, with centralized exchanges wishing to operate in the US, denying these and probably a whole range of other cryptocurrencies to US customers. Again, there is a screaming need for robust and liquid decentralized exchanges. While you may not personally miss Lisk or Ardor, this could be the start of a worrying trend, and I hope that it isn't. And although maximalists may rejoice since Bitcoin is not a security, personally, I see nothing positive about this story. So I hope that we don't see it continue to be a trend. And of course, in all of this happening, we have our good friend Tether, who does the rest of the community no favors at all with their bad behavior. Now, according to Tether's own attorney, Tether actually did invest in instruments beyond cash and cash equivalents, including Bitcoin. I mean, hey, look, seriously, on the one hand, really good investment, guys, if you timed that right. On the other hand, screw you, Tether. Stop it. The lies of Tether know no end. All this stuff comes out in court proceedings, not transparently. But Tether says it was just a small amount, so really nothing to worry about here, guys. I know every other word out of the representatives of Tether's mouths are lies, but we can believe on that one, right? Their attorney is now claiming that the New York Attorney General is acting beyond his jurisdiction and trying to exert regulatory authority over Tether. And yeah, I kind of agree, but maybe if Tether stopped doing all of this shady crap, it wouldn't have regulators sniffing up their butts anyway, guys. Magical, isn't it? Anyway, as always, just my 2 Satoshis. You guys let me know what you think about any of these stories down below in the comments section. If you did enjoy today's video, leave a thumbs up on it. You can always subscribe to the channel if you are new around here. Long live the blockchain, and peace out till next time.